Disney's earnings report is poised to reveal a streaming giant at a crossroads. Will it soar or stumble amid shifting viewer habits? Imagine the iconic figures of Walt Disney and Mickey Mouse gazing out from their perch in front of Cinderella's castle at Magic Kingdom Park in Orlando, Florida, as captured on May 31, 2024. It's a snapshot of timeless magic, but behind the scenes, Disney, DIS, is gearing up to unveil its fiscal fourth quarter results tomorrow, with analysts eagerly awaiting insights into its evolving media landscape. Wall Street's spotlight, once again, shines brightly on the company's streaming and traditional TV divisions, where the battle between old-school broadcasting and modern on-demand services continues to unfold. But here's where it gets controversial. Disney's decision to halt detailed reporting on subscriber counts and average revenue per user (ARPU), a metric that measures how much money each subscriber brings in, mirrors Netflix's NFLX own pivot earlier this year. For newcomers to investing, think of ARPU as the per-person profit gauge for streaming platforms. It helps investors see if users are truly valuing the content enough to sustain the business. Disney will bid farewell to these figures for its streaming services, encompassing Disney Plus and Hulu, in this report. This shift raises eyebrows. Some argue it's a savvy move to dodge scrutiny on slowing growth, while others see it as a transparent evolution in how media companies adapt to a world where viewer loyalty fluctuates wildly. Let's break down what experts from LSEG predict. An earnings per share, EPS, of $1.05, which is basically the company's net profit divided by its outstanding shares, a key indicator of profitability per share for investors. And total revenue reaching a whopping $22.75 billion. For those just dipping into finance, EPS is like a report card grade. Higher numbers mean stronger performance. To put this in context, Disney recently shared that Disney Plus boasts nearly 128 million subscribers, while Hulu stands at 55.5 million. And in a nod to expanding its digital footprint, the company rolled out the ESPN direct-to-consumer app in August, bundling all its TV network content into one convenient package. This launch could be a game-changer, offering fans seamless access without the bulk of traditional cable. Much like how streaming apps have revolutionized home entertainment. And this is the part most people miss. Starting with this quarter, Disney is also phasing out subscriber and ARPU tracking for ESPN+. It's a bold step, potentially simplifying investor communications, but sparking debate. Does this mean ESPN+ is becoming less central? Or is it just streamlining metrics in a crowded sports streaming space? Adding another layer, Disney implemented price increases for its streaming tiers back in October. For example, if you've been a Disney Plus subscriber, you might have noticed those extra dollars per month creeping in. Often justified by premium content like exclusive Marvel films or Star Wars series. But it can test viewer patience in a competitive market where free alternatives or ad-supported options abound. Here's where opinions diverge widely. The final subscriber update will offer clues on whether Disney's temporary suspension of Jimmy Kimmel Live in September impacted viewership. The show was yanked after host Jimmy Kimmel's remarks on conservative activist Charlie Kirk's comments about assassinating President Donald Trump and the MAGA movement. The hiatus, lasting mere days, reportedly led to a wave of cancellations on Disney Plus and Hulu, as reported by media outlets like The Hollywood Reporter. Was this a principled stand for free speech and safety, or an overreaction that alienated subscribers? It's a hot-button topic. Some hailed Disney for swift action against inflammatory rhetoric, while critics question censorship in entertainment, especially when it ties into political divides. Of course, streaming isn't the only arena drawing attention. Investors are keeping a close eye on Disney's traditional TV networks, including ABC's broadcast lineup and cable favorites like ESPN and FX. As more viewers ditch bundled cable packages for a la carte streaming, think cord-cutting trends fueled by services like YouTube TV or Sling. These networks face headwinds. Take peers like Warner Bros. Discovery, WBD, who've lately disclosed earnings showing persistent drops in ad revenue for linear TV. Disney, too, has noted declines in operating income and advertising dollars for its broadcast and cable arms in recent quarters, illustrating the broader industry shift toward personalized, on-the-go viewing. So, as Disney steps into the earnings spotlight, we're left pondering the future of entertainment. Will this report cement streaming as the undisputed king, or highlight cracks in the magic? What do you think? Does Disney's handling of controversies like the Kimmel incident strengthen or weaken its brand? And in your view, is ditching subscriber metrics a smart evolution or a red flag for investors? Share your thoughts in the comments below. I'd love to hear differing perspectives on how media giants should navigate these turbulent waters.